Hi everyone, Maria Tyler here. In today's video we're going to look at ratio analysis. So ratio analysis hopefully will provide us with a little bit more insight into the business just by using its financial statement. And we do this because we're trying to figure out or glean mathematical relationships between the financial statement figures. So it is mathematical, it's a calculative analysis, and we use the financial statement data. So it's using the historical data, and hopefully we're trying to identify, we're just comparing one figure to another. We call that a mathematical relationship. So for example, the very first ratio that we'll look at is called the net profit margin. We're simply comparing net profit to sales and looking at the relationship between those two figures from the income statement. So for every dollar of sales, how much are we turning into net profit? So that's the net profit margin. So ideally you want a higher net profit margin because you want to be turning most of your dollar into net profit. Unfortunately, in the real world, it doesn't work that way. So, but we're just looking at the relationships. Now, we do group them into three main areas. So we have profitability ratios designed to show us how profitable, or to give us indications of how profitable a business might be. We have liquidity and efficiency, showing us how liquid or can they pay their short-term debts, and how efficient are they using their assets. So liquidity and efficiency ratios give us indications of those. And long-term solvency or gearing, which is how have we structured or financed the structure of our company. So have we predominantly used outside or external debt, or have we funded it through owners' share issues and so forth. So long-term solvency is the third main group. In our particular unit, we separate them into original or general ratios, and then of course we have our specific restated ratios from which we'll use the restated financial statement data. So in this unit, the ratios that we will actually use, we won't use all the ratios that I'm going to go through, but I find that they're quite useful, and I'd like to go through more than just what we use in this unit, just to give you a bit more of a complete picture. It's by no means comprehensive. There are a lot more ratios out there, and you can even make up your own ratios as well, because really a ratio is just expressing a mathematical relationship between two figures, or two or more figures. So in this unit, I've highlighted the names of those ratios in red, just to give you an idea of that's what's going to be in your spreadsheet. So in general, so these are the general ratios. I'm going through the general ratios first, and then I'll go through our restated ratios at the end. So the general ratios, which we'll be using our original financial statement data for, starts with the profit margin, which I explained before. It's for every dollar of sales, how much are we turning into net profit? And return on assets is very similar. For every dollar of assets, how much are we turning into net profit? So what return are we gaining for investing our money into the assets of this business? So again, with these two figures, you do want to see it higher. Higher is more favourable. Return on equity, same concept again. What return are we getting for the equity that we're putting into this business? So again, you do want to see a higher figure. Now, we don't calculate this particular ratio in this unit, but we do calculate this in the restated ratios. So I'll cover that when we go down, but the concept is the same. Okay, continuing on with profitability ratios. These profitability ratios are more to do with shareholder returns, so we call them market ratios. So earnings per share, now your companies actually calculate this for you, but we don't want you to use the company's calculated one because they tend to round their number of shares. They show you their calculation anyway. It will be slightly different to the one that you calculate, and we want to see your calculation because that shows your understanding of it. But essentially this is for every dollar that we've put in, for every share, how much have we earned for that share? So if I own one of the shares in Wesfarmers, how much has that share earned for me this financial period? So it divides our total profit by the total number of shares issued. So total profit that Wesfarmers has been able to generate for this financial period divided by, or spread across, if you like, the total number of shares on issue. So every single shareholder, if Wesfarmers was to distribute all of the profit to all of its shareholders, how much would every single share earn? How much would everyone get? So that's earnings per share, and that's actually a very commonly quoted figure in the financial press. So earnings per share, and it's also part of why it's included, because it is so commonly used. It's automatically included, or the companies have to calculate it and include it on their income statement. So you would have noticed it. We didn't enter it into our financials, so that was the section I said just ignore, don't enter that in, because for our unit, we want to calculate that ourselves. We don't want you to use the one that your companies have already calculated. So if this is how much the company could have paid out per share, then why didn't they pay this amount out per share? This is what this tells us. So dividends per share is how much the company actually paid out of the earnings. So let's just assume, say earnings per share was $1.50 per share. So for every share on issue, they could have been paid $1.50 as a return, but the company may only have paid out 50 cents per share. So they're actually retaining some of the earnings and not distributing it as dividends, because they want to invest in the assets in the future, or the company's operations. So companies, it's very common to have a larger figure for earnings per share and a very small figure for dividends per share. Now, Wesfarmers actually pays out a significant amount of dividends, and you'll find that larger established companies do that. Startup companies or smaller companies, or companies that haven't been operating for that long and don't have quite a strong asset base yet, they generally won't pay any or very large dividends. They will pay smaller dividends, if any dividends at all. And of course, if the company is making a loss, i.e. they have negative earnings per share, they won't be paying any out in dividends. So I think Virgin Blue for a number of years, Virgin Australia now, for a number of years they were making a loss and they did not pay any dividends. So earnings per share is the earnings per share, so profit divided by number of ordinary shares. The dividends per share is dividends that were paid divided by number of ordinary shares. So how much they earned per share, how much they actually paid back to the shareholders per share. Price earnings ratio, now this means different things to different people. Actually, all the ratios could mean different things to different people. I'm just explaining my view of them. But price earnings ratio is a bit of an interesting one, because I used to explain it as, I see it as a measure of inflation of a share. So when I'm doing my own investing or looking at companies in terms of for my super fund, I don't like to see a higher price earnings ratio. I prefer lower price earnings ratio, because if I see a higher one, to me it's more inflated. Now, a manager, one of my students I was teaching the MBA to a number of years ago, he said he prefers a higher price earnings ratio, because he looks at price earnings ratio in terms of expectation about future profitability. So if he sees a higher price earnings ratio, to him that means, well, people must be expecting good things of this company, or the market price wouldn't be so high in relation to its earnings. So he prefers a higher price earnings ratio, and it does encompass all of that. So price earnings ratio is really a comparison, as the name suggests, of the market price to the earnings of that company. So that's why it's called the price to earnings ratio, price earnings ratio, or PE ratio that we commonly call in practice. So it literally takes the market price of the share and divides it by the earnings per share, this figure up here. Now, one of my students, I was explaining that every year, I explain it like that. One of my students a number of years ago said to me, "You just confused me with your explanation. It's really simple." Price earnings ratio to him, when he looked at comparing the market price to its earnings, he said, the price earnings ratio simply tells you how long you're going to be paid back for your investment. So he says, for example, if I invested $5 into this share and it paid me $1 back every year, then it would take me 5 years to be paid back for my investment in that share. And I thought, actually, that's a really good way of explaining it. So have a look at the mathematical relationships between these figures and make sense of it for yourself. That's what we're asking you to do in your assignment. So I'm going through and I'm telling you my understanding of these ratios, but you might find an easier or more basic or novel way of explaining it so that others can understand. And that's what we're looking for. So for that student, explaining it in that way, that was a spot on way to explain it. For me, that was a 5 out of 5 explanation. So price earnings ratio really just compares market price to the earnings of that investment. And however you want to interpret that, I'm looking forward to reading in your assignments. But essentially that's it. So price earnings ratio is a measure of inflation, how inflated a share is. It's also a measure of how long the share is going to take to pay you back based on these earnings per share. This denominator here, the bottom figure, is actually this ratio that we've calculated. Dividend yield is sort of like your term deposit interest rate. So it's what dividends you did get paid back for your share divided by the market price, divided by the investment amount. So it's like I said, like your term deposit. If you think about it in conceptually, it's the interest you earned on your term deposit divided by your term deposit investment amount. That'll give you the percentage interest rate. Dividend yields the same things. The dividends you got paid divided by the investment amount, which is the market price for that share that yielded the dividend amount. So it's a percentage. So again, the dividend yields is the dividend rate that was paid back to you for your investment. So it's your investment rate. So again, you do want to see this higher. It generally isn't very high because companies, like I said, prefer to retain their earnings rather than distributing it back out to shareholders. So dividend yields, think about it in terms of interest rate, return on assets, return on investment. Dividend payout simply compares these two figures to each other. So it says how much, well, what percentage did they actually pay out of what they could have. So this is potential 100% what could be paid out. How much did they actually pay out? So if you actually divided these two figures together, you would get the same figure as the dividend payout figure anyway. And if you look at it mathematically, the ordinary dividends is already here as the numerator, and the net profit after tax minus preference dividends is the numerator here. And again, that just shows one divided by the other. So the dividend payout compares what could have been paid out with what actually was paid out. So we only look at the first three for this unit, or we only calculate the first three for your firms in this unit. So that's profitability ratio. So the previous slide where we went through the general profitability ratios, we look at these two in this unit, and the shareholder and market profitability ratios, we only look at the first three in this unit. Okay, moving on to the next group, which is our liquidity and efficiency. So liquidity looks at, can we pay our short-term debts? Do we have enough cash and short-term assets to pay our short-term liabilities, our immediate liabilities? That's liquidity. And efficiency is how efficiently are we using our assets? Are we overworking them or are we underworking them? So obviously we want the nice balance, equilibrium in the middle, where we're not overworking them, we're not underworking them, but we're using them at the most efficient point as possible, you know, economics and where the lines meet. So we're using them at equilibrium they're most efficient. So first of all, liquidity. So current ratio tests liquidity, and it simply compares current assets to current liabilities. So for every dollar of current liabilities, how many dollars of assets do we have to pay? So at least you'd want to see 1-to-1, at least with current ratio. You want to see at least, if you've got $1 of liabilities to pay, you want to at least have $1 of assets, current assets, to pay that with. And it's interesting to note actually with ABC Learning Centres a number of years ago, their current ratio was manipulated to show that they had enough current assets by reclassifying some non-currents to current. So they wanted to show that they had enough current assets to pay their current liabilities. This current ratio is commonly linked in real life to a lot of loans, particularly business loans. So a business, especially a new startup business, that the bank might say, well, we actually require, before we say you must pay us this money back, before they start foreclosing, we require a certain current ratio, say 2-to-1. So for every $1 of current liabilities, we require you to maintain at least $2 of current assets. So this is a really important ratio that's used in practice. You'll probably come across this if you work in the banking finance sector in the future. So we do calculate this in this unit. It's in red. The quick or acid test ratio is more of a stringent test than the current ratio. Essentially, it's the same thing. It measures for every $1 of liabilities, how many cash assets do we have? So it says, okay, let's take our more stringent current assets. Let's not include all current assets. Let's include just cash and short-term money market equivalents of cash and accounts receivable. So assuming that we can call up our customers that owe us money and actually ask them to pay that cash, which is also questionable. But anyway, the quick or acid test ratio just takes more stringent current assets and divides it by our current liabilities. So again, another measure of short-term liquidity. Our receivables and inventory turnover and assets turnover, this is measures of efficiency. So how efficiently are we collecting money from our customers? How efficiently are we selling our inventory? And how efficiently are we utilizing our assets to generate as profit? So essentially that's what these measure will give us an insight to. So receivables turnover tells us how quickly we are receiving our money for making our credit sales. So we obviously sell to credit, to our customers on credit, we let them pay later. So it compares our net sales revenue with the average amount that's outstanding for these customers to pay us back, our credit customers. So how quickly are we turning over our receivables? How quickly are we collecting our money? And you can make that into a number of days figure by dividing 365 days by the receivables turnover figure. That will tell you how, on average, how long it's taken you to collect your money from your customers. Inventory turnover, same concept. How quickly are we selling our inventory? So from the point where we actually purchase our inventory to the point where we actually turn it into a cost of sales, where we actually sell it, how long is that period? So again, the inventory turnover figure simply states how often we are turning over our inventory into sales, and that, again, you can see that in the mathematical formula. If you divide the inventory turnover figure into 365, you'll get this figure, days inventory, and that's what we actually calculate. So we do the average inventory, average daily cost of sales, this is where we put the 365 in, and I'll show you how to do that when we actually go through our company spreadsheets. So number of days inventory, how long is it taking us to sell our inventory from the time we purchase it to the time that we actually sell it? The asset turnover is a measure of how efficiently we are utilizing our assets to generate sales. So how often are we turning the value of our assets, of our average total assets, into sales? How often are we turning that dollar figure over into sales? So again, with all of these, you generally do want to see a quicker figure, because a quicker figure means, with the receivables turnover means that you're collecting your cash quicker from your customers. With the inventory turnover, it means that you are selling your inventory faster. And with the asset turnover, it means that you are using your assets to generate sales faster, or a lot more sales. So generally you do want to see high figures, but you don't want them to be too high, because if it's too high, for example, you might be overworking your assets, and that's not sustainable. And that could lead to longer or larger costs in the long term. So you don't want to be overworking your assets, you just want to be working them sustainably. So yes, we'd like to see larger figures, quicker figures, so bigger figures here, which means more faster turnover, but not too fast. And we should always be benchmarking against industry. So that's liquidity and efficiency. So the first two on liquidity and the last four on efficiency. Now in this unit, we only do the current ratio for liquidity and the last two for efficiency. The last group of ratios that I'll cover is the financial stability or solvency or long-term financial structure ratio. So how have we geared our company? Have we predominantly funded our assets with debt or external borrowings, or have we predominantly funded it with owner-generated funds such as shares? So with long-term stability, we calculate a debt and an equity ratio, which simply measures what proportion of your assets are funded by debt or equity. So both of these ratios should add up to 100%, because if it's not funded by debt, it's got to be funded by equity, or vice versa. So for example, if you have a debt ratio of 40%, your equity ratio will be 60%. So you can see your total assets is both a denominator figure here, the bottom figure, and then on the numerator, the top figure, it's liabilities or debt and equity. And again, if you think about your balance sheet equation, assets equals liabilities and equity, you can see that whole picture of the pie together in these two ratios. So debt ratio plus equity ratio always has to add up to 1 or 100%. The debt equity ratio is different to each of these. It compares one to the other. So the debt ratio, debt ratio is this one, the equity ratio is this one. The debt equity ratio takes those two and compares them to each other, so divides one by the other. So if we continue our example of 40% here and 60% here, if you divided the 40% by 60%, you would get 0.67, which means for every dollar of equity, 67 cents is being put in to fund the assets of the business by an external party, such as a bank. So it compares, the debt equity ratio compares the debt to the equity component. So it says for every dollar of equity, how much is being put in by a debt, external debt, or the bank, or some other external financing. So debt equity ratio is different to these two. That's very important. A lot of people think they're the same. They're not. Times interest earned is simply how many times does our profit cover our finance costs, essentially. So we use earnings before interest and tax rather than net profit after tax, because again, for management purposes, interest is a financing function and taxation is generally out of the manager's control. So they use profit before interest and tax usually. So earnings before interest and tax divided by all of our finance costs. Finance cost expense and finance cost capitalised, because sometimes companies capitalise for accounting reasons, finance costs on the balance sheet. So finance costs on the income statement and finance costs on the balance sheet, add them together, that's all of our finance costs all together. How many times does our profit cover this figure? So again, you want that to be higher, because that means you've got a higher profit to cover your earnings. And again, if you find that your company doesn't even generate enough profit to cover your interest costs, they've got problems. They're probably too heavily geared, too much in debt, and that can be a problem with long-term solvency. They may not be able to pay their debts as they fall due, and the company may actually have to be wound up or closed. So times interest earned is a pretty important long-term financial stability indicator. Now in this unit, we only calculate the equity ratio and the debt equity ratio. So that's our general ratios. Now I'll just cover our restated ratios. So there's only 6 of them, 6 restated ratios. And again, they're pretty much the same concept to what we've covered already. And you can actually, in your assignments, I expect you to compare one with the other, because that's the whole point of restating. Our original financials were how our companies presented them, and our restated financials are restated in terms of operating and financing. So the ratios I've just been through are based on our original financials, and the ratios I'm about to go through now are based on our restated financials. So we should be able to see the difference between the same ratios using different financial statement figures, and hopefully glean some further insights from that. So again, our return on equity I covered up above in our profitability ratios on the first slide. So it's this one. So we don't calculate this one in this unit, but we do calculate it for the restated ratios. So we use comprehensive income and average ordinary equity. So CI, this is what we put in brackets, and that's why I said you can see a lot of the acronyms on this slide. And when we were entering and restating, doing our restated financials, I said make sure you put in brackets your acronyms, because it will be so much easier when you come to calculate these ratios. Just looking at this acronym, oh, I need OI here, so click into the OI cell, wherever you've put OI, click into the NOA, click into your RNOA, your NFE for your net financial expenses, and so forth when we go through on the next slide. So hopefully you've used your acronyms. It'll make life a lot easier. So return on equity, how much return are you generating for your shareholders? So we're looking at comprehensive income, dividing it by the average ordinary equity. So again, you want to see a higher figure here. Higher figure is more favourable. Return on net operating assets is same as return on assets that we looked at in the profitability ratios on the first slide. So return on assets, again, looking at the return for the use of your assets. So how much of for every dollar of assets, how much are you generating in profit? And that's the same concept with our restated return on net operating assets. How much are we generating, how much profit or operating income are we generating from our operating assets? So again, you want to see a high figure. And talk about the comparisons, because you calculate both of those. So you calculate the return on assets using your original financial statement figures, so you'll get a percentage figure there. And then you also calculate the RNOA, or the return on net operating assets, using your restated figures. So compare them. Is one higher than the other, and why? Look at the inputs. So we calculate RNOA here. Profit margin, again, we've looked at that in the first slide. So we use the operating income divided by our sales for our restated ratios. Originally on our general financial statements, we looked at that here. It's again our profit divided by our sales, but from our original financial statement figures. So for every dollar of sales, how much are you turning into profit? And we calculate that for the original financials. We also calculate that for the restated financials here. So you should be able to compare one to the other. Is one higher than the other? Why? Look at What have we done between the original and the restated? We've separated into operating and financing. So we've left out the financing items. So has that made a difference to the profit? Is our profit margin higher from our operational assets? So this is all very interesting. You can have a look at your firm and see what further insights you can glean. Now, economic profit I haven't covered yet, but in the study guide, it is covered in a lot of detail. And if you've studied economics already as part of your degree, or if you've done any other studies into economics, you'll have an understanding of this. But essentially, economic profit covers opportunity cost. And opportunity cost is the cost of the next best alternative. So what you would have been able to put your money into if you hadn't gone with your current decision. So it looks at making a profit to not only cover the funds invested into this particular decision, but also to cover the cost of not investing in your next best alternative. So we call that opportunity cost. So economic profit takes into account the cost of capital, so that opportunity cost. And you can see it factored into the equation here actually. RNOA, which is our return on assets, that's RNOA. And you have to explain that as part of your assignment and into its drivers, but more about that later. So RNOA, take away, so this is a percentage figure, or can be a percentage figure, take away your weighted average cost of capital, so I call it a WACC. Your weighted average cost of capital is a very commonly used acronym in the real world. And again, companies actually have a set WACC usually. So the study guide tells you can actually just use 10% for this, but I would encourage you to have a look at your company's annual reports and just see if they have their own WACC that they use, their weighted average cost of capital. And if they do, use that instead and write about it to your market, so your market knows that you've actually taken an understanding of the weighted average cost of capital and had a look and found it, that your company uses it. Now, sometimes a company won't tell you, or they'll say, look, we do use the weighted average cost of capital, but they don't list it. In that case, just use 10%. 10% is the easy option. And so we say, okay, so this is the return that our operating assets is generating us. Take into account, so take away the cost of capital. So that's the extra profit that we're generating over and above our cost of capital. And then multiply that percentage figure by your net operating assets to get an economic profit, just to make it into a dollar value, essentially. So this is percentage, this is dealing with decimal points and percentages. So our return that we're generating, take away our cost of capital, so covering our opportunity cost. This is the amount of return or profit that we're generating greater than our opportunity cost or our cost of capital. So this is the profit over and above it. And then turn that into a dollar figure by multiplying it by your net operating assets from your restated balance sheet. I left the divided by 1 there because I couldn't format out this line. So divided by 1 is just leave it as the top line. So if you've got negative or a very small return on net operating assets, i.e. less than your weighted average cost of capital, so you might have a negative percentage figure here or a negative decimal figure here, then of course your dollar figure is also going to be negative. And that's fine, because you know that you expect it to be, because you've got a very small return or a negative return here if you've actually got a loss instead of operating income or profit. So always explain and analyze your figures looking at your inputs, because what might be for one company might not be for another. Then one company might have a profit, one company might have a loss, and so forth. Okay, so that's economic profit. That's our profitability ratios for our restated financials. Now we'll just have a look at a ratio under financial stability and one under efficiency for our restated ratio. So you only have to do six ratios for your restated financials. So we have a look under financial stability at net borrowing cost, which again is, think about it in terms of your interest rate on your loan. So when you go out to get a home loan, they say, okay, we'll lend you this money and we're going to charge you an interest rate on your home loan of 7%. Okay, so this is what this calculates it. It calculates your interest rate, if you like. We call it the net borrowing cost. So it says, what's your finance costs after tax, and what was your total borrowings, your net financial obligations, so NFO from your restated balance sheet. So this was our net finance costs after tax, and this is divided by, so we're saying how much interest have we paid, how much did we borrow. So essentially it gives us an interest rate. And then that would be really interesting to compare to your firm's loan rates, because some firms in their financial statements will actually disclose how much they're paying in interest on their loans, on their long-term borrowings in their notes. So you can actually say, well, I've calculated their net borrowing cost at 6%, but they're actually paying 7% on their loan. So actually this is really good. They're not paying as high. Essentially on their financial statements, their net borrowing cost isn't as high as their loan cost. Or you might find that their net borrowing cost is a lot higher than the interest on their loan. So it's not a true indication. So the 7% interest is not a true indication of all of the costs of that borrowing or of that debt. So again, this can be quite interesting, but that's what it calculates. And under efficiency, how efficiently are they using their assets? Same concept as what I explained under the efficiency ratios for the general. On the second slide, I think it was. Yeah, so this one. So the asset turnover, how efficiently are we utilizing our assets, using our general financials? So the same concept under the restated, we're simply using sales and our net operating assets. So we're leaving out the financing assets from here. So how efficiently are we using our operating assets to generate sales? For every dollar of operating assets, how much are we generating in sales? How often are we turning over the dollar value of our operating assets into sales? So again, you want to see a higher figure. You don't want to see it too high because that might mean that we are overworking our assets. So compare this figure to your asset turnover that you calculate for your general or original financial statements and see, is there any difference? And if so, explain it. And that's what we're looking for in your assignment. So that's pretty much all of the ratios. I know that was a little bit dry, but hopefully that's given you a bit to talk about in your Word documents when you actually have to go through and explain all of your company's ratios. Please use your own words, so understand each one and then explain it in your own words. There's a number of limitations of ratio analysis. It is performed on historical data. It's not used on forecasted data. We use it as a measurement base. Year-end data might not be representative of what actually happened during the period, because the balance sheet only shows a snapshot as at one point in time. There is a general lack of disclosure in our general purpose financial reports, and again, you'll probably find that when you're going to look through for prices such as your market price, and figures, such as your market price and so forth. So there is a general lack of disclosure. There could be some one-off or non-recurring items that's skewing your figures. This is actually a really important one. In 1 year, there may have been, for example, discontinued operations, which made a huge loss. And so when you calculate your ratios for all 4 years, you'll see nice profits. And then that 1 year will be this huge negative figure. And you'll be like, what did I do wrong? You go back and have a look. And that'll be that one-off, non-recurring, hopefully non-recurring item that has skewed your figures. So when you're explaining that, write about that in your assignment. Say, well, it's actually huge and negative because they had discontinued operation in that year. They realized it was making a loss, and so they got rid of it. And so that's why there was a huge loss in that year. And then the next year they generated a profit or whatever it is. But just make sure that you are, if there is 1 year that looks funny, 1 or 2 years, investigate why. So ratios are just little red flags that indicate something might need investigating. So just because we look at it and we say, oh, well, this is good or this is bad, it's not necessarily the case. It's just an indication saying you might need to investigate to see if it is good or if it's bad. And of course, some entities just may not be comparable. They're in different industries, different economic climates and so forth. So there are a number of limitations, but generally it is useful. And if you just realize that ratio analysis simply shows you mathematically a relationship between two figures on the financials, then hopefully that will help you in your understanding of what you can use it for, and you don't apply it to outside its scope, essentially. Okay, so tips for us when we complete our assessment, the ratios component. There's a few preparation items that I would like you to do to make life easier when you're actually calculating the ratios. Identify the number of issued ordinary shares. Usually you can find this in your PDF annual reports. Identify the market price of your shares. Sometimes your companies will disclose this in their annual reports, sometimes they won't. If they don't, you need to go onto a main website, so any sort of finance or stock exchange website, so for example the Australian Stock Exchange or Yahoo Finance or Google Finance, because they all list market prices of shares, and usually you can type a date in of a company on those finance sites, and they will actually show you the share price as at that date. So if your company doesn't tell you in your annual report, then you may have to look elsewhere for the market price of shares, but identify this first. And also identify your cost of capital. Don't spend too much time on this. Just have a quick search through your company's PDF documents. If you can't find it, just use the 10% suggested in the study guide. But do state that you have had a look so your market knows that you were a bit proactive and tried to find your company's weighted average cost of capital. Your ratios must be fully linked. Do not type anything into your ratios other than a formula. And I'll show you as we're going through how we can put these in a little working section down the bottom and link to those as well. So if you've accidentally made a boo-boo with one of these, you can correct it down here and it will flow through everywhere you've linked that above. So make sure that it is fully linked. All your ratios need to link to the original financials except for your restated ratios, which should be linked to your restated financials. So all of these ratios need to be linked to your financial statements tab, your original financials, and then all of these ratios need to be linked to your restated financials tab. So make sure that you are linking the whole lot to the correct set of financial statements. Okay, so now we're going to complete the linking. So take the time to pause the video and go and get your PDF reports, get your completed company spreadsheet up to your restated income statements. So you should have completed all your restating. Use your completed company spreadsheets. Go and get your annual reports because we'll need to look through those for number of ordinary shares, market price and cost of capital. And make sure you've got access to the internet to search out market prices of shares if your company doesn't tell you what those are in the actual annual reports. All right, so pause the video now, go and get those and come back and we'll do the ratios. Okay, so you've got all your documents here. So what we're going to do is the preparation now. We're going to go and identify these three items. We're going to put them in the bottom section of our spreadsheet. So we'll identify the number of issued ordinary shares as a number, not a dollar value. Identify the market price of our shares as at the balance date every year, and then identify the cost of capital for our firm. So just go to your ratios tab in your spreadsheet, scroll down to the workings area and link your years up here. So we've got a year, we don't need that. Let's go and format painter this actually. Paint with my paintbrush, all those, and drag this across. Okay, so I've got my years up here. My first one's going to be my number of issued ordinary shares. My next one's going to be my market price per share, and then I'm going to do my weighted average cost of capital. So my WACC, my weighted average cost of capital. Now my number of issued ordinary shares, go back to my annual report and open my 2017 up first and search, so Control F, and let's put in, say, ordinary shares. Now sometimes actually what I should have done was go to the notes on equity in my balance sheet. Let's go and do that first actually. Let's go home, let's go to my financial statements, go to the balance sheet, and let's just see under the notes here, note 12 it seems to be is my equity for issued capital is note 12. So I'm going to go to note 12 first. Here's note 12 and just see, because sometimes, here we go, note 12. Let me zoom that for you because you can't really see that, and move that over here. Look at that, note 12 actually tells me all the info I need. Ordinary shares in thousands. This is what I want in dollars. Not in dollars. I know the dollar value because that's what the balance sheet lists. I want the actual number, not the dollar value. I want to know how many are there on issue. So you could actually search that by doing the search like how I showed you, ordinary shares, which eventually would have brought you here anyway. Would have picked up this for me. Or you can just go to the note and equity. If your company puts a note in the balance sheet about issued shares, it might actually tell you how it's split up, how they've arrived at those values in the balance sheet. So that was the easy option for me. Note 12, so I'll do that for the 2015 report as well, because the 2017 report I can get my number of ordinary shares, my figures for 2017 and 2016. So this is as at 30 June 2017 and this is as at 30 June 2016. Now, it's really important to note the denomination here, because remember, our figures in our financials are in millions of dollars, from, well, my Wesfarmers financials. So I need to express my number of ordinary shares in millions of shares. So I need to make sure my denominator and my numerator are going to be the same, because in my financials, I'm comparing the dollar figures to this number of ordinary shares. Remember on our, I'll just go and have a look. Bear with me for a minute till I find the correct slide. Here we go. So our weighted average number of ordinary shares issued, weighted average number of ordinary shares issued. Notice that we're comparing a dollar figure, this one here, and that's a dollar figure, with a number, which is not a dollar figure. So if I'm expressing my dollar figures in millions, I also need to express my number in millions as well. So whatever denominator your dollar figures are, your financial statements are expressed in, you need to also express your numbers of ordinary shares in that same denominator. So I'll just go back to the slide that we're on. We're doing this section now. So in terms of Wesfarmers, my dollar figures are in millions. I also need to make these figures in millions. They've only expressed them in thousands, which means there needs to be another 3 zeros here. So what I'm going to do is write the full figure in to start with and then convert it to millions. So it's expressed in thousands, which means they've left off 3 zeros. 1,000 is 3 zeros. So as at 30th June, I'm going to type in 1133840000 into my financials. So 1133840000. That's my number. Make sure that I convert it to a number. And the reason there's little hashes means my cell, my column width is not wide enough to fit that all in. So I can just double click here to make it wide enough, or I can just remove the decimal points, whoops, and then double click that again. Okay, so that's my number of ordinary what did I, make sure I put that in correctly. It's very important to get this right. 1133840000. 1133840000. Now I missed a 0 on the end. 1133840000. I've forgotten because it was a percentage, sorry. These are formatted as percentages, so I might just want to format Paint of that so that we don't get the percentages. So check that you've entered it as the full figure first. Now I want to express it in millions of dollars. So a million has 6 zeros, so I need to go back 6 decimal places. So 1, 2, 3, 4, 5, 6, and put a full stop in there or a decimal point in there, and then hit enter. That's how I need it to be expressed. Now I can increase my decimals. That's how I want it to be expressed when I'm linking from here, because all my figures here are expressed in millions. I need my numbers of ordinary shares to also be expressed in millions. All right, it's very important. Now, harped on that point. Let's move on. So for 30th of June 2016, so my balance, my number of ordinary shares for 2016 is 1126131. 1126131 and go back 6 decimal points, 1, 2, 3, 4, 5, 6, and put a dot in there. Let's increase my decimals as well. Now for 2015, I've got to go to my 2015 annual report. So I'm just going to go down to this equity section in my balance sheet. Here's my financials. Oh, it's not going to let me. Let's go down to page 87. My financial statements. Oh. That's my statement of changes in equity, my cash flow, and here's my balance sheet. So again, it's still note 12 in the 2015 report. So I'm going to go to note 12 and see if my number of ordinary shares is there. Actually, let's just see if a search would bring it up as well. Ordinary shares. Oh look, it almost brought me straight to note 12. no, 12. All right, so this is good. This is what I want to know. So as at 30 June 2015, again, they're expressing it in thousands. So I'm going to write the full number in and then go back my 6 decimals. Or I can just write this number in and go back 3 decimals, which is what I'm going to do. So 1123753. 1123753, and go back 3 decimal points and put a full stop in. So I just want to convert it to the same denomination as my dollars. Now 2014, so as at 30th of June 2014, this was my number of ordinary shares. This is the dollar value, this is the number. I want the number, it's very important. Don't use the dollar value, use the number. 1143275. Convert it to my millions. Okay, so that's my number of issued ordinary shares done. That will make my life much easier when I do these two ratios. Now I need to find my market price per share. And I don't think, well, they have. As at, so that would have been the share price as at 30 June 2014, but they haven't told me for 30 June 2015. So I'm just going to do a bit of a search. I'm just going to put share price and see what comes up. That's for, this looks like it's for their employees, part of their employees. Eligible executives were invited to receive, and that was the share price then. Here we go. Weighted average share price in 2015 was this, and in 2014 was this. That's cool. I'm not sure, I think this is to do with equity settled awards, so I'm just going to keep searching for now. Again, share-based payments, they've got shares there as well. Manage your shareholding. Share prices can be accessed. Oh yeah, so again, if they don't tell us this, we'll have to go to the stock exchange. They've actually given us a link to the ASX where they're listed as a public company. Just keep searching. In previous years they have given me their share price. Here we go. I knew they had. So Wesfarmers, I knew just from working with them from previous years that they actually do tell me their share price. Your companies may not, or they may. So just have a bit of a search, search them through, and then if you can't find it, then you can go on to, for example, the stock exchange website and have a look through, or Google Finance or Yahoo Finance. And have a search there. But in this case, Wesfarmers has given me my share price as at 30th of June for each of the years, actually. So I wonder then if I can go to my 2017 report and find the same thing, and that'll tell me share price. That'll tell me for all of the years, and I only have to look at one report then. Maybe not. Oh yes, here we go. Let's zoom this a little bit. So that's great. This tells me my share price, my closing share price as at 30th of June for all of the years that I need, my last 4 years, these ones here. So I'll just go and enter them in. So $40.12, $40.10. It's putting it in percentages. I want that one in dollars, actually. 40.12, 40.10, 40.12, 40.10, 39.03 and 41.84. 9.03 and 41.84. Yeah, that's right. Okay, so I've got my share price. So that was nice and easy for me. Okay, so if your company doesn't give you your market price per share, make sure that you go on to one of the websites and try and locate that. They will be, all of your stock exchange websites list the share price, and you can, I know with this Australian Stock Exchange website, you can actually put a date range in, and then it brings up a little graph, and you just hover your mouse over the share price at each point, and it will actually tell you what the share price was. So you can find out the share price as at 30th of June on each of those for that period. If you say, look up your company's share price, historical share price for the last 4 years, so from 2017 through to 2014, and then hover your mouse as at 30th of June on each of those dates and just look at the little share price that comes up, and then you can get your figures that way. So that's market price per share. Now we have to do the cost of our capital. So cost of capital, I'm just going to have a quick look in the annual reports, just see if they do a cost of capital. So they do tell us a little bit about cost of capital, but I can't see a figure. Let's go next. They use a weighted average cost of capital. This is their WACC, the WACC that I'm talking about. They haven't told me what it is yet. Invest above the cost of capital. That doesn't tell me the actual percentage figure. Okay, so I can't find where they've actually listed their cost of capital. So I'm going to use 10%. So just have a quick look in your company's financial statements. Actually, before I move on, let me have a look at my 2015 report and see if it shows me anything in there. Cost of capital. Now, it might not always be called cost of capital, actually. So even though the weighted average cost of capital is the general term, with the smaller companies, they might, or the more foreign companies, they may not actually call it a weighted average cost of capital. They might call it a discount rate. So a discount rate or a capital investment rate or a capital cost. So they're the main terms that I can think of off the top of my head that they might call them. But essentially it's the cost of using capital or funds to fund their assets. I'm just having a quick look to see if I can find that percentage cost of capital. And if I can't, I will just use 10%. Okay, so don't do any more than that. Just have a quick, we don't really want you to spend too much time on that. If you can't find it, just put 10% in. Use 10% for all years. So that's what the study guide tells you to do. All right, so see how I've expressed it now? My numbers of ordinary shares as a number, expressed to do 2 decimal points. You can express it to more if you like. Market price per share in dollars, and weighted average cost of capital as a percentage rate. Now you can also express this one as a decimal rate, in which case this would be 0.1 if I was to express it as a decimal. All right, so that's our preparation. Now we're going to link our ratios. So we're going to link all of our ratios to the original financials except for the bottom 6 restated ratios. And literally, so this is the ratio, this is the formula for the ratio, and I've explained what each of those ratios means in the previous part of this lecture. So net profit after tax equals, go to our original financial statements, find net profit after tax. So where's our, here we go, CI, right down the bottom. I think that's the last one. Yes, for me. So I'm doing net profit after tax. Now you could take this profit as well and we wouldn't mark you wrong. So this is our profit and loss before comprehensive items. This is our final net profit after comprehensive items. So I like to use the very, very last one. So that divided by our sales, which for me is revenue. Now I could include total revenue, or could just include my main revenue. I like to put total revenue when I'm talking about the original financials. So sales, your company might actually have sales, in which case just link to your sales figure. In my case, it's probably not going to make too much difference whether I link to this cell or this cell, excuse me, because this is so small. Like the finance income as a proportion of total revenue is very small. So I'm just going to link to this one, total revenue. And now that I've done it once, this is the beauty of linking. Don't have to touch anything else. Just link it through, fill it through, and it automatically calculates based on, as long as you've formatted your original financials correctly and you've put them all in as numbers and not a text, and no dashes for zeros and things like that. If you put a dash for a 0 in 1 year, it'll come up with hashtag value, which means you need to go back and take the dash out and put a 0 in. So it has to be all formatted correctly. That's why it's important to get your originals corrected before moving on. That's my net profit margin. For every $1 of sales, Wesfarmers is turning 4 cents into profit. Half a cent into profit in 2016, 3.6 cents. So that's pretty small in my view. Anyway, you can talk about this in your assignment. I'm just showing you how to calculate them. So return on assets equals net profit after tax divided by total assets. So go back to my net profit. divide that by, so slash in Excel to divide, by total assets. Here we go, it's total assets. Make sure you're using it in the right column. So I'm using my 2017 column. Once I fill the formula in once, that's all I have to do. Excel does the rest for me. It's beautiful. I love it. So for every dollar of assets, I'm generating 7.2 into net profit. So again, is this very good? Well, as a return, thinking about a return. If you put your money in the bank, what could you get now? 2 or 3%. So if you compare it to that, then a 7% return is probably all right. A 0.8% return is probably not all right. So I would have a look. Can you see how my numbers for 2016 are starting to look a bit skewed? Something might have happened in 2016. This might be one of the impact of one-off non-recurring items. Something might have happened in Wesfarmers in 2016. So my ratios showing my mathematical relationships between my financial statement figures are already indicating that something needs investigating in 2016. So I might actually go back through and have a look at what happened in 2016 and see why did they have such a small profit in that year as opposed to all the other years. Notice their profit's very small. So I might actually go through and see what's happened. Did they have something different in this year that they didn't in previous years? And that might be grounds for me to write about that in my assignment. This is all very good things that you can do. Okay, keep calculating our ratios. Okay, days of inventory. So this is how long is it taking us to sell our inventory. So it equals our inventory. Now some companies, this is important, some of your companies may not have inventory. They might be purely service companies. Now, it's very unlikely that that's the case. Pretty much almost all companies will have inventory. But, even if they are service companies, but your company may not. So have a look on your balance sheet under current assets and see if it's got inventory there. If it does, you can calculate this ratio. If it doesn't, then you need to write about why you can't calculate this ratio in your Word document. Now, beware, inventory is not always called inventory. It may be called raw materials, work in progress, finished goods. There might be a number of different names for inventory, and we'll look at that in the follow-on unit as well. But for now, just go and have a look at your balance sheet. Let's go to our financial statements balance sheet. Under current assets and see. So Wesfarmers does have inventories, so I know I can calculate this ratio. So link to it. I have to divide that by, now I want to explain this a little bit, the average daily cost of goods sold. So I need to find my cost of goods sold and divide it by 365. So to do that, I put divided by. Excel does this automatically. So divided by, after your slash or divide sign, open your bracket, because we need to do that formula. We need to tell Excel to divide our cost of goods sold by 365. Now, again, cost of goods sold, your company might have different names for this. They may not list it as cost of goods sold. If they do, that's nice and easy. If they don't, you have to think about what type of business your company is and what type of things it's going to be selling as its inventory, and then see if there's something similarly named on the profit and loss statement. So I'm going to go and see on Wesfarmers if they do my cost of goods sold, and from memory, I don't think they do. Let me just scroll down to my profit and loss statement. So under expenses, sometimes some companies will list cost of goods sold as a negative revenue up here, like a bracketed revenue, but most of the time it should be listed somewhere here. So they haven't, so Wesfarmers hasn't listed it as cost of goods sold, but they have listed raw materials and inventory. And I know that's my cost of goods sold. So in my case, Wesfarmers is not calling cost of goods sold or cost of sales. They're calling it raw materials and inventory. So I'm going to link that and divide it by 365. Now, because it's a negative figure, I've entered it as a bracket. I also need to make sure that I'm taking away that bracket. In this case, I don't need to know the negative figure. Some cases you do need to leave it as a negative, but in this case I don't. So like, for example, profit and losses, you usually need to leave them as a negative or a positive. But in this case, I'm simply comparing how many days it's taking me to sell my inventory from the time I purchase it to the time I sell it. How long is it taking me to turn over my inventory into sales, to turn my purchase inventory from my balance sheet into cost of sales on the profit and loss. I don't need to know a negative figure for that. So if you've entered this as a negative, following my example, just put a little negative sign in here just before your bracket to negate that. Make sure you close your brackets at the end, then hit enter. That's as a percentage. We don't want it as a percentage. We want it as a number. So just hit your little comma, which formats it to a number with 2 decimal places. Okay. This is expressed in number of, as the name suggests, in number of days. So at the moment, in 2017, it was taking Wesfarmers on average to sell their inventory approximately 52 days. So just over a month from the time they purchase their inventory to the time they sell it. Now, again, you've got to interpret these figures in light of your company. So Wesfarmers does operate Coles, which is a large amount of their financial statements. And also they operate Officeworks and a number of other large stores. So I need to look at this and go, well, in general, is that acceptable? For some food items that are sold in Coles, it obviously wouldn't be, like milk. But for other items, such as stationery and Officeworks, then it may be acceptable. In fact, the stationery is probably skewing it out to a longer basis, and the inventory that's sold in Coles is probably skewing it to a shorter. So on average, is this acceptable? I don't know. I would have to go to industry benchmarks for other similar companies to Wesfarmers and gauge whether this is acceptable or not. So when you're explaining these, again, you just need to make note of all these sort of items and issues. This is where I would explain it in my Word document. The important part where you can show some more insights about whether or not these figures are good is the trend. So look at the trend. What so far can we see that's occurring? Our net profit has been declining, a net profit margin. Our return on assets declined really badly and then sort of stayed the same, 6.8 to 7.2. Our number of days it's taking us to sell our inventory is slowly getting longer. So it took us 47 days in 2014 and now it's taking us almost 52. So the trend's not looking that good for Wesfarmers. So make sure that you're also analysing, in addition to the individual years, you're also analysing the trend. That's probably the more important part. Look at the trend of these ratios. Okay, moving on. Total asset turnover ratio. So sales divided by total assets. Nice and easy. Revenue divided by total assets for me. Leave this one as a decimal point. This is how many times are we turning over the dollar value of our assets into sales. So you generally want to see a bigger figure here. What's the trend telling me? We were turning 1.5 times the dollar value of our assets into sales, and it's slowly been increasing. So that's good. I'm glad that it's increasing, because generally you want a higher figure, but not too high, because that means that you could be overworking your assets. And I don't think 1.5 to 1.7 is considered high, so I'm happy with those. Now let's look at liquidity. Are they able to pay their current liabilities with their current assets? So go to our balance sheet, current assets divided by current liabilities. Leave this as a decimal. This is not good. I want to see at least a 1-to-1. So the trend is not good. It's decreasing. They had at least 1-to-1 back in 2014 and they haven't since. So their short-term liquidity is not that good. Let's have a look at their debt equity ratio. So it's debt divided by equity. So let's have a look. Debt is total liabilities divided by total equity. 67%. You can leave this as a percentage. So for every dollar of equity of a shareholder of Wesfarmers that they put in, for every dollar that the shareholders have put in 2014, 53 cents was put in by the bank. That's slowly been increasing, so it looks like they're increasing their debt. So 63 cents was put in 2015, 77 cents, and they decreased it this year to 67 cents. Still higher than the original back in 2014. Let's have a look what's happening with their equity. Based on this, I would expect their equity ratio to be going down. Let's have a look. So equity divided by total assets. Total equity divided by total assets. Fill it across. So again, what I expected is true. So 65% was funded of the assets were funded by shareholders in 2014, and that's been decreasing down to 60% now, just under 60%. So they've been increasing their debt. And actually, if I was to calculate the debt ratio, which really is debt divided by equity, you don't have to do this, but I just like to show you. Let's go and do it, which is my total liabilities divided by my total assets. Fix the formula up. Oops. Okay, so my debt divided by my total assets, both of these should add to 100%. See that? That's what I'm saying. So if we were to do our debt ratio, we could actually see that our debt is increasing from 34% up to 40% over the last 4 years. So something's going on with their borrowings. You don't have to do these. So I'll just highlight them in yellow. Not required, but just wanted to illustrate part of what I was discussing in the lecture. Okay, so that's our profitability, efficiency, liquidity, and financial structure. Now we're doing our profitability market ratios. This is where we need to link to what we had looked earlier down before, what we set up. So earnings per share. Now Wesfarmers has already calculated these at the bottom of their income statements, but I'm going to calculate them myself. So I need to go net profit after tax to my original financials. Let's go net profit after tax divided by my number of issued ordinary shares. This is here. That's why I said life is much easier now for me. And this is actually dollar figure, so you can put dollar signs on that. So $2.55 in 2017. Their earnings per share has slowly been increasing. That's pretty cool. Let's go and have a look at what Wesfarmers calculated, just out of interest. So in 2017, I calculated earnings per share of $2.55. Wesfarmers in 2017, let's just go to their financial statements. So in the income statement here, they've calculated the earnings per share. This was the section I said don't worry about putting this in. So they've calculated in cents, earnings per share attributable to ordinary equity holders of the parent. Basic earnings per share, that's what we're looking at. $2.54.7, so $2.55 and 36 cents for 2016. What did I calculate? That's almost the same as what I've calculated. That's pretty cool. So I've calculated $2.55 for 2017, and so have they. $2.54.7, so rounded up to $2.55. And they calculated 36 cents, and I calculated 29 cents for 2016, so slightly out as well. So go back and have a look at the difference between your company and what you've calculated. Just note, your companies usually, for some reason, they express earnings per share in cents, not dollars. Difference between basic and diluted earnings per share. I have this question every year. So basic earnings per share is the number of is what we've just calculated. So it's profit divided by all of the shares that are currently on issue. So that's the numbers that we've got. Diluted earnings per share is profit divided by all of the shares on issue plus all of the shares that could be on issue. So all of the what if everybody exercised their rights and their bonus share issues and all the other options on current shares. If all of those options and rights and warrants were exercised, how many shares could there be on issue? And usually that will be a much larger number. So it dilutes the profit. It dilutes that earning per share. That's why they call it a diluted earnings per share. So basic earnings per share is just profit divided by currently issued shares. Diluted earnings per share is profit divided by currently issued shares plus potential issued shares. So it's a larger denominator which dilutes the profit figure. Okay, so that was just a bit of a aside. Dividends per share equals the dividends. Now, dividends you will usually find in the statement of changes in equity. if they've paid any, under the transactions with shareholders, like right down towards the bottom, divided by number of issued ordinary shares, so down the bottom of this sheet. So go back to our ratios first, our original financial statements. And let's see, here you go, equity dividends. Again, Wesfarmers has put them in, they've shown it as a negative equity, which is fine, but for this particular ratio, I don't need to show it as a negative sign. So I'm actually just going to put a little negative symbol in here because I don't need it shown as a negative, and I've entered it as a negative. Divided by my number of ordinary shares down here, hit enter. And fill that across, and that's $1. So this is what it per share, this is the earnings, and per share, this is what was paid out in dividends. That's actually a large amount that was paid out. Your companies would probably be something like, 0.02, like 2 cents, if they've paid any at all. So dividends per share usually is not this large. Wesfarmers, as you can see, actually pays a large proportion of their earnings out to their shareholders to keep their shareholders happy. In 2015, they actually paid more than their earnings, and same with 2016. So they actually only earned $2 per share in 2015. They paid $2.31 per share out to dividends to shareholders. And in 2016, this was our investigate year. They had a very small profit, and they actually still paid out a large dividend. So shareholders obviously are expecting these large dividends every year. So that's interesting. So you can compare those two. All right, price earnings ratio equals market price per share, which we calculated earlier, divided by the earnings per share, which we've just calculated above. See, earnings per share, which is this ratio. So link those two, hit enter. Leave this as a decimal point. So it's 15 times inflated, almost 16 times inflated. The inflation is decreasing though. It was 17, almost 18, and it's gone down to 15. Now, again, depending on how you interpret this will depend on your position. So for me, I like to see a smaller figure here. So I like that this is trending in the right direction. The manager, who was my student a number of years ago, he would think this is not trending in the right direction. He likes to see a larger figure, which means there's a better expectation of future profits for him. And my student, who said I was confusing in the way I explained it, and he explained it in a much neater way, would say in 2014, it would take Wesfarmers, someone to invest in a share in Wesfarmers, it would take them almost 18 years to be paid back, as opposed to somebody who invested in a share in Wesfarmers in 2017, it would only take them almost 16 years to be paid back. So obviously we don't look at 2016 because their figures were skewed because it had such a small profit in that year. So the earnings per share is based on profits. So let's ignore the one-off. This is what this is called, the impact of one-off non-recurring items. You can, if it's skewing your figures, you need to just ignore that in your explanation. So overall, looking at the trend, it's decreasing. The price earnings is decreasing. So you interpret that how you will. Okay, that's all the ratios linked to the original financial statements. Now we're just going to do the last 6, and we're going to link those to our restated financials. We want to see all of these ones linked to this tab, the restated financials. Okay, so starting with 2017, return on equity is CI divided by shareholders' equity. So CI, which we've actually put right at the bottom of our income statement here, CI divided by shareholders' equity, which is total equity here from our balance sheet. That figure's actually the same as your originals, but we like to link it to the correct sheet. So return on equity, we've calculated. So let's look at the trend. So in 2014, shareholders were getting a 10.4% return. In 2017, they're getting a 12% return. Is that good? Again, that's up to you and your perspective. The trend is positive. Generally, you want to see a larger return figure. So the trend is trending in the right direction. So this is good. Remember, what's different with these ratios to our previous ratios? We've separated operating items from the financing items. So we're gleaning further insights into the business. All right, return on net operating assets. This is the one that you want to compare to our return on assets above. So let's go and calculate this one first. OI divided by NOA. So OI from our restated income statement. Here it is. See, OI, my little acronym. OI divided by NOA. Here's my little acronym, NOA. Leave it as a percentage. So this is the one I'm going to write in here. This is the one that you want to compare to your return on assets from above. So we can actually go and have a look. So you don't forget, when you're talking about it in your Word document, you might like to write that there too, to remind yourself to compare it to your original financial statements figures. So our return on assets, again, is trending fairly constantly. It's about 10% in 2014. It's still about 10%, slightly increasing to 2017. Let's go and compare those figures to our return on assets here. So the trend is the same, but look at the difference in figures. So when we've separated out the financing items, our return gets much better. So this gives us a better indication of how Wesfarmers is utilising their assets for operations. So this is better. We've separated the operating assets from, instead of just using total assets, we've separated out operating assets. Instead of using net profit, we're using operating income, not financing income. So when we just look at the operational side, our return is a lot better. So this is good. This is a positive sign. Okay, our net borrowing cost, again, this is like our interest rate on our loans. So let's have a look. Net financial expenses after tax. This is actually NFE. So NFE divided by NFO, we should write that in. Hey, make it a bit easier. So when you're looking for acronyms, this is NFE. This one here is NFO. It's usually in there. That's a bit different. Okay, so NFE divided by NFO. So equals, we'll go looking for NFE in our income statements. Right down the bottom. Here it is. See, NFE, I've typed in. NFE divided by NFO. And I've usually put NFO up above too. Now, again, you've got to look at negatives here, because usually your net financial expenses will be negative. You'll have entered them as a negative because they're an expense. So you don't need to know the expenses. You need to just negate that. Well, I need to negate it in my case because I don't have net financial, I have net financial expenses. What I'm comparing is not negative to positive. I'm comparing the amount, the dollar amount of finance costs to my finance liabilities. So you just want it to be a positive figure because you need to actually compare that cost. So you're trying to calculate an interest rate, if that makes sense. So again, let's have a look. This is the cost, the net borrowing cost, or the cost of my debt. In 2014, it was about 7.6%. So we're thinking about it in terms of an interest rate on our loans. And it's been decreasing to the point of it's only about 2.88%. Now, this is interesting because before, remember we noted that their debt is increasing. They're actually increasing their borrowings, yet their net borrowing cost is decreasing. So they're obviously able, so they found a good source of financing. Well, it appears that they're finding some sort of good source of financing where it's actually decreasing the cost of their loans. So it might warrant further investigating, but it's looking like the cost of those loans actually are quite serviceable. This is positive. Okay, profit margin. This one we want to compare to our profit margin above, but let's go and calculate it first. OI divided by sales. In our restated financials, OI, right down the bottom here, divided by sales. Do my total operating income. And fill it across. And I'm going to write here, compare to your net profit margin from above. So this will remind you that you can compare these figures. So have a look at the trend first and then we'll go up and compare. 4.77. For every dollar of sales, we're turning 4.7 cents into operating income. Is that good? I still think it's a bit low, but it might be average and acceptable for Wesfarmers as a company. Let's have a look at the trend. It's starting to decrease, so not favourable, not very favourable. We compare that to net profit margin up the top here, the trend is the same, and it's about the same. We've separated out operating from financing items, and really we haven't got much difference in profitability in the actual profit margin. So that's telling me that most of their income statement is to do with operations. There's really not that much financing aspects on their income statement as well in relation to their profitability. So when I'm comparing it, I would write about that. So I just put compare to NPM, which is this one here. Your ATO, your asset turnover, not the Australian Taxation Office, your ATO ratio you can also compare to your total asset turnover ratio here. Let's go and calculate it. Sales divided by NOA. So sales, I'll do total operating income. So sales divided by NOA, which is here in my balance sheet. And fill it across and put here to remind myself to compare to my total asset turnover ratio from above, which is this one here. My total asset turnover is my TATO. So compare my ATO to my TATO. My ATO, my asset turnover, with my restated to my total asset turnover. So again, the trend is the same. So slightly increasing in efficiency, and utilizing my assets to generate sales. But look at the difference. So it's slightly improved. My turnover is slightly improved when I separated out my financing from my operating items. So that's good. That has definitely helped. Now, economic profit on itself, you get separate marks for this. And you need to, it has its own section which you need to explain as well. So economic profit it's very easy to calculate, but to actually explain it, you have to explain the drivers of it. So do that in terms of the 4 key drivers in the underlying mathematical equations used to calculate the economic profit, and that's explained in the study guide. Anyway, to calculate it, let's put equals, open brackets. We need to do our return on net operating assets, which is a percentage up here. Take that away from my weighted average cost of capital percentage, or whatever figure you found in here as a percentage, close brackets, and then multiply, which is asterisk in Excel, my net operating assets from my balance sheet, which is here. That is a dollar value, so change that to dollars. So don't negate the negatives in this one, because it's very important to be able to interpret your economic profit based on correct figures. So you need to know what's negative and so forth in here. For example, you might actually have, as I have in this year, a lower return than your weighted average cost of capital, in which case that's obviously going to be a negative in that year. So this is why I've got a negative. And again, in 2015, I only had 8.2%. So that didn't even cover my cost of capital in that year. So again, I'm going to have a negative in that year. In the other 2 years, it's a positive because I've got a greater return than the cost of my capital. So make sure that you're explaining it in that way. And that's it. So that's the ratios completed. So now, once you've completed calculating the ratios, you get marks for calculating your ratios. You also have to do a bit of theory. So show us your understanding of all of these. And this is where you can actually go through in your Word document and explain your company's ratios. Explain them each year, the trend of it in relation to other firms, and also what is this telling me about Wesfarmers as a whole business. So if you address all those aspects, you should get some pretty good marks in your assignment. Good luck and have fun.